vote however you want in terms of the election, but in terms of your portfolio, what matters most are the fundamentals: earnings, interest rates, economic data, and of course, the key to all of that is the health of the U.S. consumer. And right now, there's nothing that suggests to us that the U.S. consumer isn't in good shape and that we won't remain on a slow growth, not no growth economic track.
Right, Jim, but you would only take political risk off the table if you were working with the foregone conclusion that President Trump is coming back, given how positive he has been for the markets.
Well, I think even if President Trump prevails for a second term, there will be potential risks for a market which has had a decadal bull run here in the U.S. Valuations certainly could get ahead of themselves. That doesn't mean that there aren't other areas on the globe where we're seeing good valuations, certainly steeply discounted prices relative to the U.S. marketplace, especially in the small and mid-cap camps, not just in the established foreign markets, but in selective emerging markets. But we also think this is a time where investors ought not to take risk out of nor off the table, certainly not out of their portfolio. We run very carefully designed risk-adjusted portfolios with plenty of bond buffers in the mix, but also some cash and reserves so that if we think there is some sort of clear trajectory, we can buy on what we would be fairly confident would be dips that would rebound.
What does that look like in terms of diversifying your portfolio then? What's the drinking the coffee in between martinis equivalent when it comes to investing?
Oh, we love battleship balance sheet, blue chip dividend growers. We like healthcare despite the obvious political risks to trading prices, especially given this election year. But long-term, hard to argue against the necessary demographics, emerging market demand for better, less invasive healthcare. We continue to think that there are bargains to be had in the established foreign markets, especially in the small and the mid-cap range. But we also like total bonds, actively managed spectrum of income-producing instruments with greater or lesser interest rate and credit risk. And then again, I'd come back to making sure you keep some powder dry. Have a little bit of cash in reserve, if not as an outright buffer for down days, at least to be able to buy your favorite ideas at a discount when the dips occur.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.